reflects the pressing need to demystify the far-reaching implications of this legislation. As practitioners, advisors, and states to interpret, apply, shape compliance, corporate governance, and business operations. We are privileged to have with us Mr. Joseph Alatishe, a distinguished Associate Director, Tax and Regulatory Services, West Africa in Deloitte and Touch Nigeria, whose expertise and presentation will illuminate the practical dimensions of the new tax regime. Participants can expect a comprehensive exploration of the bill's provisions, clarity on its technical aspects, and practical guidance on how to transition smoothly into the new framework. Beyond the text, today's presentation will highlight strategies for risk management, opportunities for efficiency, and the broader economic impact of the reforms. And very importantly, I extend my sincere appreciation to Deloitte Nigeria for their continued collaboration and commitment to knowledge sharing. I also wish to acknowledge the steadfast support of our branch chairman, Mr. Adeniyi Quadri, the executive committee, members of the Finance Advisory Committee, and the dedicated members of our dear branch, whose encouragement makes initiatives like this possible. And finally, I urge all participants to engage actively, ask questions, share perspectives, and observe the insights that we share. Let us leave today's section not only better informed, but also better equipped to serve our clients, strengthen our practices, and continue meaningfully to Nigeria's evolving financial landscape. Thank you once again for being here. I wish all a productive and rewarding section. Thank you, everyone. I would like to call on the branch chairman, Mr. Adeniyi Quadri, to give us his opening remark. Thank you, sir.
Can you hear me? Can you hear me? Hello?
We can hear you, sir. Very well, sir.
We can hear you, sir.
Okay. Thank you, Madam Chairman of the Financial Advisory Committee, distinguished senior advocates, esteemed colleagues, dear professionals, ladies and gentlemen, good morning. On behalf of the Executive Committee and members of the Nigerian Bar Association, Ikeja Branch, I'm delighted to welcome you all to this very important webinar on understanding Nigerian tax landscape. Today's session is the product of a purposeful collaboration between our great branch, the Ikeja Branch, and Deloitte, an institution whose expertise in tax and business advisory continues to shape conversation within Nigeria's economic space. Nigeria is undergoing one of the most significant tax reforms in recent years. These changes are not merely adjustments to rates and procedures. They represent a structural shift with varied implications for how individuals, SMEs, and large corporations plan, comply, resolve disputes, and ultimately thrive. For lawyers, this new landscape presents both responsibilities and opportunities. As legal professionals, we must rise above traditional practice and position ourselves as trusted tax advisors, professionals who understand not only the law, but also the commercial realities clients face. The era where tax was seen as a niche area is over. Today, every corporate restructuring, every business transaction, every regulatory compliance issue is influenced by tax considerations. If we must serve effectively in 2026 and beyond, we cannot afford to remain on the sidelines. This webinar therefore comes at a crucial moment. It comes at a crucial moment. Our goal is simple: to break down the reforms in clear, practical terms, to help our members see how these changes impact our clients and our practice, and to equip all of us with insight needed to turn tax reform into real strategic advantage. We are fortunate to have in our midst, as was said, top industry experts, Mr. Joseph Alaje from Deloitte and Dr. Philip Afolani from the University of Lagos. They will guide us through the complexities of the new tax laws and highlight emerging opportunities in compliance, advisory, restructuring, and tax dispute resolution. Let me also add that the participants will earn 1 CBD points, which underscores the branch's continued commitment to promoting professional development and legal excellence. I thank Deloitte for this fruitful partnership and commend our Financial Advisory Committee, chaired by Ms. Ganiat Adisa, the branch treasurer, for their dedication in making today's webinar a reality. Distinguished seniors and colleagues, ladies and gentlemen, Nigeria is changing, and the tax environment is changing with it. This session is your chance to stay ahead of that change. Thank you all for joining us, and I wish us all a very impactful and enlightening session.
Thank you very much, sir, for that illuminating short speech. I would like to call on one of our committed members from the Finance Advisory Committee, Ms. Keji Odutola, to please read the profile of our moderator for today, an Associate Professor of Law from the University of Lagos, Faculty of Law. Thank you very much. Ms. Keji Odutola, you have the floor. Thank you.
Good morning, Chair. Morning. Good morning, distinguished seniors and colleagues of our moderator for today's webinar. Dr. Philip Folarin is an associate professor in the Faculty of Law, University of Lagos, where he teaches and conducts research in the law of taxation, labor law, law of contract, as well as business and commercial transactions law. He is also a managing partner at Phipson Solicitors, a litigation and corporate practice law firm. Dr. Folarin was called to the Nigerian Bar in 2008 and has since presented papers and participated in numerous academic conferences within and outside Nigeria. He is widely published in both national and international journals. Dr. Folarin is an associate member of the Chartered Institute of Taxation of Nigeria and a member of the Chartered Institute of Arbitration, UK. He's also an active member of the Nigerian Bar Association, Nigerian Association of Law Teachers. Distinguished Leonard Silks, colleagues and seniors, I am sure that with him moderating this webinar, we are poised to get the very best out of this webinar. Thank you.
Thank you very much, Ms. Keji Odutola. Let's welcome our moderator for today, Dr. Philip Folarin. You are welcome on board, sir.
Thank you very much. I appreciate the opportunity to be here today to moderate this fourth quarter webinar series. The task before me is simple to moderate this session. And the theme of this session is from complexity to clarity, navigating Nigeria's new tax landscape. Now, just as our chairman earlier said, that Nigeria is changing and the tax landscape is also changing. And it is no longer a practice for a secluded people or professionals, but as legal practitioners, tax is now something that all of us should venture into. Now, in June 2025, 4 tax laws were signed, bills were signed into law by the president. The 4 of them, they include the Nigerian Tax Act, the NTA. We also have the Nigerian Tax Administration Act, the NTAA. We have the Nigerian Revenue Service Establishment Act, the NRSA, and we have the Joint Revenue Board Act. Now, these laws are huge paradigm shift from where we were to where we are supposed to be. And to do justice to this theme, the organizers have highlighted certain areas that our guest speaker will take us through, meaning that what is the implication of these laws to you and I as legal practitioners? What are the implications to us as legal practitioners? How do these laws impact on our daily personal and business activities, especially the personal income tax aspect of the law contained in the Nigerian Tax Act? How does it impact on our business lives? And also, how do these reforms affect compliance and risk? How do these reforms affect compliance and risk? And also, what is in these laws for us as lawyers? What do we stand to benefit? How does it impact on our practice? How do we strategize our practice so that we can reap benefit of these new reforms? What are the opportunities in terms of dispute resolution and tax litigation? To cover all these, our guest speaker is positioned to present a well thought out paper on this area. Permit me to proceed to introduce the guest speaker, Mr. Joseph Alatishe. He is an Associate Director, Tax and Regulatory Service, Deloitte, West Africa. He bagged his LLB degree with honors from the University of Abuja in 2010 and proceeded to obtain his MBA, Masters of Business Administration, from Obafemi Awolowo University. He has over 15 years of practice experience in general taxation, international taxation, and transfer pricing. His areas of specialization bestride transfer pricing planning, international tax advisory, covering financial services, consumer, oil and gas industries. He is a seasoned, thoroughbred professional with an outstanding track record of leading high-performing tax teams. He has cut his teeth in the law and practice of taxation and has assisted various clients in different industries, putting in place adequate transfer pricing, their documentations, and carrying out transfer pricing risks, assessment reviews, and providing audit support, among many other achievements. He is a proud member of our association, MBA, a member of Chartered Institute of Taxation of Nigeria, CITN, and also an active member of ICANN, Institute of Chartered Accountants of Nigeria. Ladies and gentlemen, I present to you Mr. Joseph Alatishe, who will take us through his presentation. Before I yield the floor to him, I can assure you that I've had the opportunity to go through his paper before now, and I can assure you that as far as complexity and clarity of the new laws are concerned, we are in safe hands. So thank you very much, Mr. Joseph Alatishe.
Thank you, Dr. Philip, and thank you all. It's a privilege to be with you, and I'll rest on existing protocols and go into the paper. I want to thank the MBA Ikeja Branch because this paper is apt. Like the chairman noted, there's been structural shifts in our tax laws, and that's why a paper like this is important at this point. Ms. Ganiat, if you could allow me to share my screen, I need to get permission to do. I need permission.
Very well, sir. You can go ahead, sir. Thank you.
No, I mean, it's showing me that the host is not allowing me to share. The admin needs to give me the rights to share my screen.
Okay, just give me a few minutes.
I think you need to make me a speaker.
Oh.
So while waiting for that, I could just start by introducing the paper. I think the chairman has already spoken about it, and like Dr. Philip noted.
You're now the host, sir.
Yes, I think I can now share my screen. Thank you. Right. All right. I hope you can see my screen. So
Very well, we can see your screen.
okay, thank you. So as Dr. Philip noted, and I think Ganiat also mentioned, the aim of the paper is to lay the foundation about the tax reforms that we have, and not just stop there, but also talk about how as lawyers what opportunities are there for lawyers, and how can we leverage it in our day-to-day lives, and how does it also impact society. And that's what I'll attempt to do. Maybe I will manage expectations first by noting that there is no way you can digest the entire tax reforms even in a whole day. I keep going back to what the chairman said when he talked about how much of a structural shift it is. It's major. It's a complete overhaul of our laws, and so it's not possible to go through everything in one session. But what I will attempt to do is to give an overview of the entire tax reforms and pay attention to a few provisions. While I can see, if during the course of the presentation, if you want to interrupt me to ask about a specific one or clarity on what I have noted, please feel free. Or if you prefer, at the end of the session during the Q&A, you could also then bring it up, because like I said, we cannot touch on everything. Touch on a few of them and then go into what the opportunities are for us based on them. And like the doctor had already noted, the tax reforms come in the form of 4 main laws. So to give that background, before now, or right now actually, up until 31st December, we have multiple tax laws in Nigeria. We have substantive tax laws for all the different tax types. And in them, you see different provisions, and the way it is, you then also will see the National Assembly pass one act and include another tax clause for the creation of a fund, create a fund, and then create a tax or a levy section for the funding of that fund, to create income for that fund, and that's another tax. So we have multiple tax laws. We currently have the Income Tax Act. We have the the Personal Income Tax Act, the Company Income Tax Act, the Petroleum Profit Tax Act, the Petroleum Industry Bill, the Capital Gains Tax Act, the Stamp Duties Act. We also have the Taxes and Levies Act that tries to, the military, it was a military decree at that time that tried to allocate taxing powers based on the list, the residual list, the concurrent list, and the exclusive list in the Constitution into the three tiers of government. So we have multitude, we have lots of tax acts currently. So even for tax specialists, and that's the beauty of professionals, just like we have separate or different specializations among lawyers. I think it's even more pronounced in tax because of all these tax acts, you cannot know everything, especially when the laws are all over the place. So what this reform has tried to do is reduce at least the major part of these laws into 4 acts. And as Dr. noted, they are the Nigerian Tax Act, popularly already known as the NTA, the Nigerian Tax Act, the Joint Revenue Board Act, and the Nigerian Revenue Service Act. So this is what they try to do. The Nigerian Tax Act repealed or is going to repeal 12 legislations and amend 15. So you see, the Nigerian Tax Act alone is taking care of 27 legislations. That just gives you an understanding of how I said currently we have tax laws all over the place. The Nigerian Tax Act tries to bring all substantive laws that have to do with taxation into one act. And that's what it is about. While the Nigerian Tax Administration Act is the procedural legislation that tries to bring all procedures for the assessment, collection, and accounting of revenue into one act. It is the act that talks about the different returns that needs to be filed, when they need to be filed. The Nigerian Tax Act is the one that, like I said, is a substantive one that talks about the taxing powers, or this is the revenue that is liable to income tax. This is the rate at which it should be charged in simple terms. While the Tax Administration Act is the act that talks about how to collect the taxes under the Nigerian Tax Act, how to assess them, how to account for them. The Joint Revenue Board Act is the law that establishes the Joint Revenue Board to replace what we currently have as the JTB, the body that tries to harmonize and prevent conflicts between the different tax authorities. Because like we know, because of our federal system, we have a Federal Inland Revenue Service. We also then have Inland Revenue Services for each of the 36 states, 37 when you include the FCT IRS for the Federal Capital Territory. So the Joint Revenue Board is that body that harmonizes them. And then we have the Tax Tribunal and the Tax Ombud, also created and established under the Joint Revenue Board Act. I think the major one under the Joint Revenue Board Act is the Tax Ombud. It's not something we currently have in Nigeria. We currently have a Tax Appeal Tribunal, but we don't currently have a Tax Ombudsman. And later on, when talking about the opportunities for lawyers, we'll delve a little into that. And then the last one is the Nigeria Revenue Service Act that establishes the Nigeria Revenue Service, what we currently call the Federal Inland Revenue Service, FIRS, is now going to be called the Nigeria Revenue Service. And they are supposed to account for all revenue accruing to the federal government. I'm sure as lawyers, we've had in the past the case and the lawsuit, for instance, between FIRS and NIPOST, who has the right to collect stamp duties or on postage stamps, etc. So this act attempts to say the Nigeria Revenue Service has the sole responsibility for accounting for all revenues that accrue to the federal government of Nigeria. And of course, it repeals the Federal Inland Revenue Service Act. Sorry, I cannot see. I can't change my screen again. All right. Now, so we quickly go into, that's a brief overview of the 4 acts. We will now briefly go into the impact of these acts on businesses and on individuals. And we'll start with companies' income tax, then go into personal income tax. Now, one major change, and of course, like I said, we can't do all of them. So what I've tried to do here is to highlight some of the major changes that we see coming up from 1st January. Now, the scope of company income tax has been clearly now expanded to include chargeable gains, prize, winnings, honorarias, etc. So it's now so broad that most kind of incomes are clearly noted as taxable. There was an omnibus clause already in our current laws, but now it's now clear that all these kind of incomes are taxable. I will leave it at there for now. One other major change is the definition of small company. Currently, small companies are companies that have a gross turnover of 25 million or below. Maybe considering inflation, you may say that that may not be realistic, or at least that was the thinking of the framers of the NTA. To double it and say small companies are companies with gross turnover of at least 50 million and total asset size not exceeding 250 million, and no more medium-sized companies. So why is this classification required? Because under the current laws, if you are a small company, you are exempted from paying taxes. And then if you're a medium company, you pay tax, but at a lower rate of 20%. But that lower rate of 20% is no longer there. No more medium-sized companies. Small companies are still exempted from paying taxes, or they pay taxes really at 0%. But the threshold to be called a small company has been increased. So a lot more people then have, a lot more companies may then have to pay taxes. Now, the total profits of a company has also now been updated to include chargeable gains. And I would explain what this means. Chargeable gains are gains that are accrued from chargeable assets. If you sell assets, fixed assets, you sell a car, you sell a house, you sell what we call assets, not from your normal income, from your normal day-to-day business. Currently, those assets are chargeable under a separate act called the Capital Gains Tax Act at 10%. What this has now done is, oh, it's a single company. Why do they have to file a separate return for company income tax? Why do they have to file a separate return for capital gains and all? So everything is now brought under one bucket. But what that now means is that what is currently charged at 10%, going forward from January 1st, is going to be charged at 30%. So that's a big deal. Companies or individuals selling assets will be charged at 3 times what they currently will have to pay tax at 3 times the rate they currently do. And so this is one major shift that we've seen a lot of structuring because of this particular provision, because companies are thinking about what would I even need to sell next year or 2 years? Is it better I sell now so that I do not suffer an increased tax rate? And of course, when we go into millions of dollars, this is a major this has a major impact. Undisputed profits of foreign companies that are controlled by a Nigerian company may now be taxable in the hands of the Nigerian company. And I'll just simply explain by saying, if you're a Nigerian company has a foreign subsidiary, and that foreign subsidiary, for instance, does not share dividends to become taxable in the hands of the Nigerian company, excuse me, under this rule, it will now be considered as part of the Nigerian taxable income. It's just a way of avoiding extreme tax planning. and ensure that when it's reasonable that that company should have distributed dividends, it's part of the Nigerian company's income. So it's one of those ways, one of those devices to basically increase revenue. Income earned from bonds issued by states is now tax exempt. Currently, only income from bonds issued by the federal government is exempt from tax in the hands of corporate investors and individual investors. But it's now clear that that for state governments is now also exempt. We had an order in the past that also made state government issued bonds exempt, but that order expired a couple of years ago. I can't recall what year now. So what this has now done is brought permanence to say income issued by state governments will be exempt from tax. It's also a way to encourage Nigerians to invest in federal and state governments because they all now have tax exemptions. If VAT is not paid on what we call qualifying capital expenditure, which simply means assets that you purchase, then you cannot enjoy tax deductibility. It's also a way to punish people that evade tax or do not pay taxes that are due. A major one, actually, 4% development levy. So what we currently have is there are separate different kind of levies. Like I mentioned, when the National Assembly passes a law, you then see a new levy. Where they pass the police one, there was a levy in it. We have the tertiary education tax fund, where the 2.5 or currently 3% of accessible profit levy is a major source of revenue for that fund, the third fund, and etc. So there are levies all over the place. There is the one for IT, the IT levy, 1%. So all those levies have been merged into one single levy called the 4% development levy. The flip side is why some of those levies were only payable by certain companies. For instance, when the 1% PBT was payable by only companies in the financial sector. But what now happens is this 4% development levy is payable by all companies, with the exception of small businesses and non-resident companies. Maybe I'll increase my pace now. Pioneer status incentive has also been replaced by the economic development tax incentive. Now donations, once they do not exceed 10% of profit before tax of the company, are now deductible. Currently, if the donation is of a capital nature, for instance, what I mean by that is, so in accounting, capital nature expense is one that is used for more than one tax year. So for instance, if you currently donate a car or a building to an NGO, it's not tax deductible. But going forward, it's also going to be tax deductible. It's now going to be tax deductible, deductible in determining your taxes, as long as it doesn't exceed 10% of the profit before tax of the company. And there's also a minimum effective tax rate now of 15% for residents and multinationals. So this does a snapshot of some of the changes, of the significant changes in the Companies Income Tax Act that relates to companies. Like we said, there are several, and you can ask questions on any other, but these are some of the major changes. So I'll quickly go to...
I'm sorry to interject, sir. The participants are they are requesting to see your slides.
So you can see my slides?
Yes.
Wow. Sorry. Oh, I'm no longer the host. Okay, I'm now the host. I see. All right. Or maybe I should have given you to share the slides from there, because I think, okay. Sorry. So unfortunately I couldn't see that comment. I just finished this slide. I'll just go back to the slide now. This is the slide I just went to when I was speaking about the I hope you can see my screen actually. Let me be sure.
Yes.
All right. So this is the slide I quickly went through to talk about the major changes in the company incomes Income Tax Act. And now I was now going to say, let me also now talk about the changes in the personal. Remember that, like we said, it's now one tax act, the Nigeria Tax Act, the NTA. Before we had multiple, we had the Company Income Tax Act in a separate law from the Personal Income Tax Act, but they are now all in one document. But for individuals, these are the major changes. That's for individuals, of course, that are not incorporated as companies under CAMA. The first major change is the new rates. And later on, we talk about some of the things that we hear all over the media, really. We see on social media, we see on Twitter. And I'm sure you've seen some rebuttals to say some of these things people are saying are not true. And we'll talk about a few of them. Now, the first major one is that the tax rates have been revised. For personal income tax, we have a graduated table in determining what taxes are payable, currently between 7 and 21%. Now, the table is going to be between 0 and 25%. Your first 800,000 in a year annual income is not taxed at all. So that means that's why you would hear in the news. Okay, so I think here I see now that multiple presenters can share. Okay, so you would hear in the news, for instance, people say for people that make 800,000 annual income or below, they are tax exempt. This is the indirect way they are, because they are actually taxable, but they are taxable at 0%, because we have a graduated table. The first 800,000 is taxable at 0%, then the next set of income at 15%, at 18, 21, etc., such that only people that earn up to 100 million naira in a year would end up paying at that 25%. But of course, the table goes on like that. So at the end of the day, what the new framework tries to do is to ensure that if you earn higher income, you are going to pay more. But if you earn lower, you pay less. What I mean is currently, for instance, if you earn 150 million naira in a year as your annual income, and we use the current table of 7, 11, 15, the maximum is 21. So at the end of the day, you may be paying taxes at effective tax rate. Effective tax rate is what's the average at the end of the day. If we do the tax you are supposed to pay divided by your total income, currently it may be something around 19%. But with this table, with the way it is for people that earn more, because remember the last set is 25%. That means for any income you earn over that 100 million, government is going to take a quarter of it, 25%. But remember that before that, your first 100 million would have been taxed at that graduated table. So at the end of the day, your effective tax rate may be, let's say, something around 22% when compared to currently 19%. So for those that earn more, they will pay more. But for people that, for instance, earn 2 million naira in a year, I think 2 million, let's use 2 million naira in a year, because your first 800K is taxed at 0%, your next one is taxed at 11%. At the end of the day, you may end up paying at an effective interest rate of 8% or 9%, when compared to currently that the least you will pay is 7%. So you see that for those that earn less, they are going to now pay even less than they pay currently. But for those that earn more, they are going to even be paying, they will pay even much more. So that's the way the table was designed to look like. Rent relief. Rent relief is a new addition to the law. The CRA was scrapped. The CRA used to allow you deduct from your taxes to be paid 20% of your rent. So government usually used to say, oh, because we know you're paying rent, 20% of it, remove it before we tax the remaining. But now there is nothing like that. All rents are capped at 20% of your rents, or 500,000, whichever is lower. it takes away the CRA, which used to be 20% of your gross income. So I think I mixed it. CRA used to be 20% of your gross income, but it has now been replaced by the rent relief, which is 20% of your annual rent or 500,000, whichever is lower. Not criticizing, but I think this is one that some people will say is maybe a bit ridiculous. We know the prices of rent in Ikeja. So if people's rent relief is going to be capped at 500,000, then people are saying, they are simply saying you don't want to give me relief for the actual rent I paid. Yeah, so but that is it. And remember, it's actually 500,000 or 20% of your rent, whichever is lower. So for instance, if your rent is 1 million, 20% of 1 million is 200,000. That means you won't even get a relief of 500,000 in that case. You will only be getting a relief of 200,000. It's whichever is lower. So the provision at the end of the day is, especially when you look at most of the provisions on personal income tax, it is pro-poor. For those that earn, the government is saying you need to pay more so that those that are not earning enough can get relief. So they are saying if you can afford a rent of 1 million, you don't need relief. It is only those people that are in low-cost housing, for instance, that we want to really enjoy this rent relief. Compensation for loss of office. The threshold has been increased from 10 million to 50 million. So if someone loses his or her job, or currently, if anybody loses his job and for losing that job or for being laid off, you are given a compensation of 20 million. Currently, what happens is government will not tax the first 10 million, but anything above 10 million, they will tax it at 10%. Well, what's going to happen for next year is that's going to increase to 50 million. So if the person compensation for being retrenched, for instance, is 20 million, the entire 20 million will be tax-free. But if it is up to 50 million, anything above 50 million will then be taxed currently along the personal income tax table to be added to the taxable income of the person. So like I said, the general nature of the personal income tax part of the NTA is to grant reliefs to those that earn less, but they are saying if you earn up to 50 million as your compensation for loss of office, then you are big enough, or you should be able to pay full taxes on it. That's the general way of the Tax Act. There's currently a filing deadline of 31st March in the laws that has now been removed. That's another one of that. And go quickly to this slide. There is now stamp duty changes, and the slide will be provided to all so that I don't use the entire time on the overview. Stamp duties payable by all. VAT. Sorry, give me a second. VAT recovery. Sorry about the interruption I got to my screen. I hope you can still see my screen. Please, can you confirm?
Yes, we can see your screen.
Okay, thank you. VAT recoverability has now been expanded. So let me do a little bit on this one. So what I mean is currently, only people that purchase products for resale or manufacturers enjoy what we call impute VAT. So if you are raising an invoice to a client and you're supposed to put VAT at 7.5% that you pay to government, but in performing your services, so people have also charged you VAT. As service providers, as a lawyer, for instance, all you can do with that VAT that you've been charged is you expense it. It's an expense for you, and you can maybe try to remove it from the incomes of the business. So you're not getting full benefit of it. Well, now you can use it as impute VAT, such that if your invoice, if you have it, your total invoice for a month leads to output VAT that you're supposed to pay government of 5 million naira. But you can see that you have actually incurred VAT of 1 million naira during that month. All you need to then pay over to government is 4 million naira. Of course, you can no longer use that 1 million naira you've used to offset it to do your expense. But at the end of the day, you're gaining. Maybe I should explain why I said you're gaining. Because when you hand over only 4 million to government, that means you've taken a full deduction of that 1 million naira that you've suffered as VAT. But currently, what happens is you can only use that 1 million naira to reduce your taxable income. That will then maybe the tax that, let's say, if you take an individual, because law firms cannot be companies. Let's say it's an individual, it's a partnership. So let's say that individual is taxable. Let's say the effective tax rate of the person is 18%. What then that means is the person is only going to take 18% benefits of that 1 million naira that has been incurred, which will end up maybe being around 200,000. But going forward from 1st January, we are taking full benefit of the entire 1 million naira. So that's actually a people-friendly introduction into the laws. And then there are several other inputs or several introductions under the VAT system. And like I said, please, you would have the slides. I don't want to go through every one of them because of time. Surcharge, and I'm sure I don't think I need to talk about the surcharge because it's something that has been all over the social media. 5% on fossil fuels that is supposed to start as soon as the president says it should. And then Capital Gains Tax Act. I think I've spoken about most of the issues here. Okay. So let me, okay, the unified tax rates. I think I've spoken about it. I just wanted to mention again that there's no longer capital gains tax at 10%. It is now at the rate at 30% for companies, and then the new graduated table for individuals. One other thing I came back to this screen to talk about in the Capital Gains Tax Act is the third item. It's a major one that as lawyers, when doing structuring for our clients, we should note, which is the indirect transfer of ownership of companies or assets. And so currently, it is only when shares are sold in a Nigerian company that there is a liability to tax. And I'll give an example. Let us say a company based in the US has a subsidiary in Nigeria that is selling to another company. When it sells its shares in that subsidiary, that company in the US has to pay capital gains tax on any profits. It means, let's say, on the chargeable gain that arises from selling its shares in the Nigerian company. Let us then say that that company in the US is also a subsidiary of a company in the UK. And that's the major asset it has. The company in the US has the shares in the Nigerian company. If the company in the UK, under current laws, if the company in the UK sells the US company to a third party, it's not going to pay Nigerian taxes. It's not going to pay capital gains tax in Nigeria because shares in the Nigerian company has not been sold. It was only shares in the US company that were sold. And like we said, the Nigerian company is the major asset under it, or the major company. But because was an indirect sale, it did not sell, the company in the US or the company in the UK did not sell the company in Nigeria directly. The company in the US will still be the shareholder in the company in Nigeria. It's only the company in the UK that has sold off the company in the US. Currently, it is not liable to taxes in Nigeria under Capital Gains Tax Act. Well, it's a major change that has been brought up by the NTA to say in such cases, capital gains tax would apply. And that's because government has seen that it's a major way multinational entities have actually structured their business to avoid taxes, because they then create entities in Mauritius, entities in Bermuda that are basically not doing anything. They just own shares in the Nigerian company. And when they want to sell the Nigerian company, because they know if they sell it directly, there will be taxes. They will simply sell that company in the Mauritius or company in Bermuda. While currently it's not liable to capital gains tax, going forward, capital gains tax will be triggered in those cases. So they are, like I said, and I don't need answers, but I mentioned the specific act that has to do with most of the procedural issues, and I'm hoping we recall, and that's the Nigeria Tax Administration Act. It talks about compliance, but then there are also some provisions in the Nigeria Tax Act that has to do with about what should be assessed. So some of the compliance and reporting obligations that change through these 4 laws are: number one, the fact that for permanent establishments of foreign companies and for significant economic presence, that's what we call SCP, there's a new way of calculating their minimum tax. There are 3 different things you need to compare: the withholding tax they've paid, 4% of their income, and the effective tax rate of the parent company. So the highest of the 3 is going to be the minimum tax that permanent establishment is expected to pay in Nigeria. Non-resident shipping companies, airlines, companies like maybe Lufthansa, Fly Emirates, or shipping lines like maybe MEX and all that, they are now expected to file monthly returns, because the way they calculate their taxes is different, but they are now expected to file monthly tax returns. This comes out from major compliance issues that were really in the news among tax practitioners last year. There have been little back and forth between them and the tax authority. So to avoid incidences like that where taxes can escape, they are now required to file their own taxes monthly, as opposed to the annual filing that most other companies would do. There is now physical system, what we call e-invoicing. I'm sure most of us would have heard about it. There's this new provision that I really like, that if you object to a tax assessment and the tax authority does not respond to you in 90 days, automatically it means that they agree with your position and they can't come back again to say you should pay taxes. So cases where taxpayers have been saying, because of administrative inefficiencies, these people have not gotten back to me, how will I know what my fate is? Once they don't respond in 90 days, you can take it as well as they can't raise that liability for you again. If you enjoy incentives other than those available to anybody due to tax structure, you're supposed to file a return. There is a new system for filing of the new return filing system for low-income earners. And so I wouldn't go through this slide, but what I would simply say is that the law also introduces penalties for increases the penalty threshold for different kind of infractions. Some of them are due on conviction, some of them are straight civil liabilities with severe penalties for non-compliance. So it's actually trying to increase the compliance culture. Okay, so what I want to quickly do in this slide before we then go into what is in it for us as lawyers is debunk some myths about personal income tax, because of course you hear lots of things. Sometimes I watch some videos on Twitter and I just say, okay, maybe people do not really, or maybe people have not read these laws for themselves. The first one is that everybody is going to pay higher taxes, and I'm not going to dwell on this one. I think I've explained how those that earn lower incomes currently are even going to pay lower taxes, but those that earn higher incomes are going to pay higher taxes. So it's not everyone who will pay more taxes. It depends on what the person earns. So you don't need to file tax return. If your employer already deducts money from your salary, what tax return am I filing again? That obligation is different. Even when your employer deducts salary for those people that are in paid employment, individuals are still expected to file their individual tax returns to enable them collect tax clearance certificates. Remote workers, I think, is one that you see among influencers. Remote workers do not have to pay personal income tax, or remote workers, and then of course people that earn income from social media. So even under current laws, such people are expected to pay taxes, regardless of where their employer is based. Once they are tax residents in Nigeria, all residents and those deriving income from Nigeria are expected to pay taxes, personal income tax. Only salaried employees pay income tax? No, of course, like we've said, personal income tax is payable by all residents and all non-residents that earn income from Nigeria. Now, let's talk about TIN. Some people say, oh, from 1st January, they're going to close all the bank accounts that do not have TIN. No, so that's a myth. That's not a fact. From what we expect, because if you read the NTAA, the Nigeria Tax Administration Act, it doesn't call it TIN, it says it's a tax ID. So what we expect is that framework is going to merge the TIN of companies, personal IDs that state governments have given for taxes, NIN, BVN. Of course, we're giving these people a lot of our IDs. So these things are supposed to be merged to ensure that each account has an identity that the banks can use. An application for a new TIN is required since it's now called tax ID instead of TIN. No, it's expected that all of them will be unified and everybody will have a tax ID. So there's no need for new TIN. The one that companies have gotten on registration with CAC and all is expected to be fine. Everybody in Nigeria must have a TIN regardless of income. That's also not true. The law says that taxable persons, meaning people that earn income, will be required to have a tax ID, not everyone. TIN requirement is a new policy. It's not. Everybody has always been expected since the Finance Act of 2019 to have a tax identification number. What the NTAA just does is threaten these requirements by putting responsibilities on banks, etc., to ensure that there is a tax ID for every account. All right, so this is with debunked, try to talk about some myths or some apprehensions about the personal income tax and the TIN. Let's also then go to the Value Added Tax Act. One myth is the VAT rate has been increased. That's not true. During the time of when the bills were in the National Assembly, especially when it was in the House of Reps, there was a clamor to increase the VAT rate to 12.5%, where you heard some people say Nigeria VAT rates were among the lowest in the world. And then, of course, you had different people on both sides of the divide arguing for and against. But in all of that, the VAT rate still remains 7.5. It has not been increased. Small businesses, that means, you hear some people say all businesses must charge VAT, etc. No. So small businesses, like we've said, businesses with less than 100 million gross turnover, that's per annum. They are not expected to charge VAT to their customers. It's also expected to give them, to make them competitive in the market. Tax refunds are a myth, because you hear some people say, and not without apprehension, not without reason, you hear people say the law says, the new laws allow me to get a VAT refund of my input VAT, but we know in Nigeria it is not possible for government to pay you. You know, I've heard that about cases that if you sue police or you sue the federal government, you are wasting your time, because when it comes to the point of execution of judgment, they will frustrate you, etc. It's not possible for government to give you money. people say similar things about tax refunds. That's not possible. Yeah, so while in the past we've seen that it's been difficult in a few cases or in a lot of cases, it doesn't mean that has been impossible. Companies have collected tax refunds, and the system, or at least the provisions in the NTA, are expected to give taxpayers greater powers to get refunds and even sue governments to court if those refunds are not provided within the timelines in the law. Because currently, you can say there's no specific timeline within which I can take to go through this VAT refund process. It's clear within in the laws. All goods and services are now subject to VAT. They want to tax everything. No, that's not true. In fact, if you look at the laws, there are a lot more items that are either what we call VAT exempt or they are taxable at 0%. So because of the VAT, they are zero rated, taxable at 0%. That's also expected to ease inflationary trends in Nigeria. Of course, we know that the level of inflation we have currently is still a little bit high. All right. So I would now maybe try to take the next 15 minutes or thereabouts to talk about what it's in it for. So what I've tried to do in the last 45 minutes or so was rush through most of an overview of the Nigeria Tax Act and some of those provisions. So what's in it for us as lawyers? I think it's the chairman that was talking about it to say, to talk about opportunities. Lawyers are not left out. In fact, we are at the forefront. And that's because at the end of the day, these tax we're talking about are tax laws. New laws would always have, no matter how good the intentions of the drafters, there would always be cases of differences in interpretation. The more a law has been established over time, the less those areas would come, because certain things will either be settled by, or certain things will either have been resolved in a dispute. But this is a new law. We are going to be seeing so many clauses with disputes that would need lawyers to come in as go-to advisors in the first place to help companies know what position should I take, what position should I take that you think will be defendable before the tax arbit tribunal or before a court in future. And so we have so many of them, and I've just tried to identify a few. The first one is contract review and standardization. Companies may need to review current contracts and standardize their templates for new contracts to comply with the provisions of the what's it called? Of the Nigeria Tax Act and all the acts. And maybe I give an example. We have lots of contracts where you see a tax clause says that one, or maybe the Nigerian entity or somebody else, will be responsible for all taxes. That's a very popular clause. I'm sure most of you on the call would know what I'm talking about. Now, companies need to evaluate what that clause means to them, and I'll give two examples. Number one is under the law, as it's going to be, even maybe the last amendment to the current law, if the Nigerian entity adds the withholding tax to its expense because it didn't withhold tax from the counterparty, that expense, that additional, is not going to be tax deductible. That's one example. Or for instance, for VAT, if VAT is supposed to be charged to somebody that does not have a Nigerian team, or that's a service provider, it does not have a Nigerian team. Withholding tax, If withholding tax is supposed to be deducted from a company that does not have a Nigerian team, the withholding tax has to be deducted at twice the value. So if the contract has said the Nigerian company is going to be responsible for all taxes, that means the Nigerian company cannot withhold tax. You need to evaluate now that if that party is not, other party is not registered in Nigeria, you're going to be withholding tax at twice the value. That means that expense, you are going to be doubling the expense in your book, number one. And like I said, the entire expense is not going to be tax deductible. So you need to think about that. Maybe I should give one more example. So because of the forex issues we have in Nigeria, we have cases where the agreement has clearly said, see, you're not going to keep my money, etc. And you're going to, maybe you see people then source from the black market, etc. There is a provision in the law now that says any expense that is included in the books, not at the official rate, that expense is going to be tax deductible. That's a major one. So there are multiple several examples really of changes that may need to be made to contracts, agreements, templates, etc. And that's a work for lawyers. So this is something we should be pitching to our current clients, potential clients, to say, this is a value add for you. It's not, whatever my fee is, it's not worth the pain that you have, especially maybe if you can't do for your major contracts, to ensure that everything aligns with and avoids tax leakages. The second one is client education. Just like we are talking to ourselves as lawyers on this fourth quarter session, we also need to have sessions with our clients to tell them what this law is about. Like we said, there are a lot of myths. A lot of people only know about these tax laws based on what they see on social media, from people that are not lawyers, from people that have not even looked at the tax acts themselves. So we have a part to play in educating our clients, can be in the form of paid or free webinars, etc., going to their offices, giving them a talk. Sometimes it can be a free one that will lead to you even detecting what they actually need. Another one is tax advisory, helping them to register. Some people have not been, and I think this is where you see a lot of people, because of the apprehension, have not been paying taxes. What do? I need to register. What's this process to also get a TIN so that my bank account is not closed for those people that said that. So there are a lot of support needed in that area by companies. Transaction review, due diligence. A lot of companies need to reorganize. There are lots of M&As, mergers and acquisition, going on now. I'm sure if you're on LinkedIn, if you're online, you would have been seeing a lot. Companies have sold off, etc. They've restructured. A lot of people will be doing this now. Some have not finished. Some may spill it over to next year. All these people are looking at some of these things to ensure that there are no tax leakages come 1st January when these laws are effective. So, of course, all these processes cannot go through without lawyers. And these are the areas you should be able to scan, put your ear to the ground, meet that client, and provide the required support. But of course, to do that, we also then need to educate ourselves, get ourselves even conversant with the provisions of the 4 tax laws as they are. Okay, and that slide was basically on what we can do about taking advantage of the Tax Act, and I'm open to questions that we might have at the end. So what this slide also then tries to talk about is, so what should we as lawyers what should we be looking at even for our firms? In a lot of firms, and not without reason, you see a lot of companies don't want to take governments to court, or a lot of companies don't pay as much attention to taxes until they enter into problems. So you don't see law firms, no, at least a lot of them focused on the tax aspects. But it's a minefield, or it's a gold mine, especially with these tax laws that are coming. I was saying we should tax practices as much as possible should be looking at deal structuring, especially with the tax rates that I've talked about. And we need to also be able to see how we can optimize tax benefits for our clients, saying that tax firms we recommend should also specialize in competencies that have to do with tax laws. Consider having a specialist in taxation if you can afford. If you cannot afford, pay special attention to taxes, including international tax, transfer pricing, investigations. The oil and gas industry is a minefield where tax lawyers are required, and structuring, mergers and acquisition. Tax advisory, risk mitigation. There are lots of these provisions, one of them on the interest deductibility in the law, etc., that will require the support of lawyers. Lawyers for transfer pricing, for instance, lawyers are also required to go into this field. So these are just some of the examples we've noted. And maybe I take a little time to dwell on the last one, which is tax dispute resolution and litigation. And we've spoken about the tax tribunals and the ombudsman also. So maybe I should just say this: the distinction between the tax tribunals and the ombudsman. The tax tribunal seeks to answer the question, was I liable to tax? Based on the law, is this supposed to be so? Why the ombudsman is about fairness of the process. Was I aired properly? Was the taxman fair to me to say that I was going to do this? And why companies, especially the ombudsman, may try to also approach them themselves. Lawyers are needed in their capacity, both for litigation and ADR, pre-tax tribunals, because that's one area I see coming up a lot, because some companies are also reluctant to go to the tax appeal tribunal. They are looking for lawyers to help them to the dispute resolution system with tax authorities, for instance, when they want to go into negotiations. That's the major type of ADR we see. We see a few mediations, but a lot of negotiations. So lawyers are needed to come into this for their clients, really. So these are some of the areas we see that lawyers can mine. Legal requirements for compliance, policy engagements. Lawyers can also help their clients to drive policies with governments, engage in trainings, etc. Like you said, the slides are available, and these points are just there to discuss if we have questions. So we're saying that lawyers are needed now. Maybe let me make this point very importantly. One new introduction in the Nigeria Tax Act, where we're talking about some of these things, and I can't recall if it was the doctor that said it while introducing introducing the topic. I can't recall if the one that mentioned it was to talk about the fact that we are the ones that can represent. So the Nigerian Tax Administration Act introduces the concept of tax agents to say that only accredited tax agents can represent a company for tax purposes. We still are waiting to see the final maybe guideline or version of what the tax authorities would say, or who they would say are tax agents. But I'm aware that MBA is involved in these discussions. So lawyers should be ready because when companies are looking for who can support them, one thing they will be saying is, are you a tax agent? Are you an accredited tax agent? So that's also a selling point if we get there. And so we think it's something we should be looking at. And I think that's one of the reasons I've then put these slides to say So as lawyers, and in one of the slides, we talked about specialization in taxation, especially considering the opportunities that are going to be there in the future. So what are some of those things that, or some of those certifications that lawyers should be looking into when it comes to taxation? And especially the first two for me, and maybe the first one for taxation, is to say lawyers can look to become chartered by CI10. And the good thing about it is that being chartered by CI10 is not a long process for lawyers. You're a lawyer, you're called to the Nigerian Bar, a member of the NBA, you're not going to write any paper. I think once you've practiced for 3 years, I think it's an automatic conversion program, something like that. So that's one. It then depends on the level of specialization you want, because ICANN is an accounting related exam. It's not just going to stop you at understanding tax laws, but it's going to also help you apply the tax laws to the books of companies. So that's the advantage if you are looking to have accreditation in ICANN. And what I see is, especially when companies are looking at proposals that have to do with taxation, they look at this thing. We have CFA, we have the Institute of Chartered Secretaries and Administrators. These are that's not a tax-specific one, but it shows that you have certification that has to do, you understand the board system, you understand secretarial functions, etc., the mini system of companies, and you see it as a selling point when it comes to representing a company for tax matters. Okay, so some other certifications are here that companies can get for international tax, especially if you are looking to become an expert in international tax. You can look at IBFD courses. Some of them are free. You go online and you take them, and you can put them in your CV or put them in your proposal. An advanced diploma in international taxation. This is just like ICANN, but it's a UK body, while ICANN is a Nigerian body. Or you get an LLM in taxation or an MBA. So these are some of the options available if you are interested in that. So at this point, I will just conclude by saying, and the word, I think I've used this word multiple times here, and the chairman used it, and I'll use it again. The tax reforms in Nigeria represent a structural, enduring paradigm shift in our system. Legal practitioners that proactively invest in this specialized knowledge, they will have a competitive edge. So it's about and that's why I say this paper is timely, and thanks to the Ikeja Branch to give us that competitive edge. Not all people will go into tax practice, but it's also good that I are aware that this is one area I can pay focus on and then get opportunities for my firm, for myself. So at this point, I would pause and see if there are any questions, or not just questions, if there are any contributions, something you want to add based on what you know, or our advice, also as fellow lawyers, because I'm also looking for those opportunities anyway. So thank you very much.
So thank you very much, Mr. Joseph, for your insightful presentation. You have taken us through a very robust paper. As I said earlier, I had the opportunity to come through your paper before presentation, and I was glad with the quality of information, especially for practical purposes, contained in your paper. So once again, thank you very much for insightful presentation and for the quality of your paper presentation.
Thank you, sir.
Thank you very much, sir. While we are waiting for more questions, we have seen some of the questions in the chat box. For those of us who would like to make comments directly, you may need to signify by raising your hand electronically. And for those who are more comfortable with dropping their questions in the chat box, please, you are welcome to do so. For now, we have about 5 questions in the chat box. We are still waiting for more. While we are doing that, I would like to quickly run through an overview of what our guest speaker has presented. He started with an overview of the 4 major tax laws. He has been able to engage each of them, their aims, their purposes, and how they will impact on our daily lives and our businesses. And also, he has taken us through the gamut of specific laws, like specific taxes, like company income tax, how it has been expanded to cover taxable gains, honoraria, and awards and other subject matters. And also key is the introduction of a development levy, which he has explained to us that it has amalgamated some old taxes like the old education tax, and others. And he has also taken us through some of the innovations brought about in the area or space of indirect taxes like VAT, CGT, capital gain tax, and stamp duty. And again, he was able to explain the impact of compliance and penalties, telling us that longer business from for default for taxpayers, I mean, will now be stricter than before. So this is not a time to default in our tax duties. Then the very, very insightful aspect of his paper is myths versus facts. He has been able to demystify a lot of myths and misinformation, misinformation about these new laws. And also, he has been able to focus on opportunities for lawyers in terms of tax advisory, disputes resolution and litigation, and other aspects. And finally, he concluded with the need for lawyers to engage in a continuing education as lawyers so that we can better position ourselves for these coming opportunities that is being presented by these new tax laws. So once again, Mr. Joseph, thank you very much for a robust and insightful paper presented. Now, while we are waiting for more questions, please, I would like you to throw light on 1 or 2 areas before we yield the floor to questions and answers. In the course of your presentation, you did mention the major objective of these new laws, which include or borders on a golden principle of taxation, ability to pay principle. So you earn more, you pay more. You earn less, you pay less, which is the focus of these new laws, which you did well to explain in your paper. But there is a little concern, and I would like you to throw more light on this concern. If you recall, under the old Finance Act, so it's almost becoming old now because a new law will start operating from the next few weeks. The Finance Act seems to have exempted the minimum wage sort of from personal income tax. But now we have a new minimum wage, which has increased minimum wage to 70,000 naira. And if you look at the NTA now, the Nigerian Tax Act, that aspect or chapter that borders on personal income tax. And from there, you go to the fourth schedule, which you have also explained in the course of your presentation that, okay, the first 800,000 naira or less than that is zero rate. But if you now look at if you calculate the annual income of a minimum wage earner in Nigeria now, by the time we multiply 70,000 by 12 months in a year, that's about 840,000, which is a little bit above the minimum wage. Now, how do we reconcile that? We are under a regime now which kind of exempted minimum wage earner from personal income tax, which is a true reflection of you are not earning much, so you shouldn't pay much. And if the objective of these tax reforms is to further empower those who are not earning much, so how is it that they are still going to be liable to pay personal income tax under this new? So I don't know what your thoughts are in this area, sir.
Yeah. So thank you very much. Very, very insightful question, especially because you say a lot of things from people. So, and you've basically answered part of the question when you talked about the 0%. So I'll just tie everything together. If somebody is earning 70,000 per month, and for 12 months, that's 70 times 12, that's 840,000. Now, if the idea is that people that earn a minimum wage are not supposed to pay. But what we then said is that it is only the first 800,000 that is exempted from tax. So technically, what that means is that people that earn a minimum wage would still have to pay taxes on 40,000 naira. So let's look at it two ways. Let's say they're actually supposed to pay taxes on 40,000 naira. Remember that I said from that table, after the 0%, the next one is 15%. So what is 15% of 40,000? 15% of 40,000 is about 6,000 naira. So what that means is that the maximum they are supposed to pay is 6,000 naira. And that 6,000 naira, remember, is for 12 months. So what that means is that they are going to pay government taxes of 500 naira per month. I don't think that is out of the world. And that is the worst case scenario. Why do I call it a worst case scenario? Because before you even tax that, it's 840,000, you have to give them their relief. The first relief we said is rent relief. If you remember, I said the rent relief is the lower of 500,000 or 20% of your income. So a minimum wage earner of 840,000, let's say the person is living in a place of 100,000 per year. 20% of that is 20,000. So what that means already is that what you called 40,000 tax liable to tax it's only 20,000 that will actually be taxable at 15%, which will then be 3,000. 3,000 payable over 12 months. If you do 3,000 divided by 12 months, the person is going to end up paying about 200 naira per month. So the idea is that they're not supposed to pay anything. And at the end of the day, you see the worst they can pay is 500. And if they are living in a place of 100,000 per year, they end up paying 200 naira per month. So that's the general idea.
Okay, thank you very much, Mr. Joseph, for your detailed answer. You have given us a practical insight to that. And also, again, before we yield the floor to our colleagues who have some questions to also ask you, in the light of the indirect taxes, in your presentation also, because indirect tax affects all of us. In fact, it's even a tax that we pay not knowing that we are paying it times. And it has been a veritable source of income for government. But, for lawyers, there's been a lot of agitations in this area, especially when it comes to sharing formula between the different levels of government. What portion of the money should go to the federal government, what percentage should go to the state, and what percentage should go to the local government. And looking at all the legal battles in this area, from the time of Aberagba and AG Ogun State down to Eko Hotel and FRS, and of recent, the River State and FRS. Now, the NTA, the VAT aspect of a NTA has introduced a derivation formula that's okay, that percentage that is coming to the state and also the percentage that is coming to the local government. In total, the derivation should apply so that the equality for 50%, that is, of all the monies or revenue gotten from it, 50% of it should be shared based on equality among all the states and local governments. Then 20% should go to population, and the place of consumption, consumption, we carry the remaining 30%. So, sir, in your opinion, do you think that this innovation will lay to rest the agitations, the legal battle that has plagued this aspect of tax from time immemorial till now? Because some states still believe that we are generating over 50% of all the money. So do you think this derivation will at least address some of these problems?
So that's a difficult question to answer. That's a question that needs me to project into the future. But our attempt, and I would say it would at least lay those yearnings to rest for now. And at the end of the day, what we have in the law was a political solution, because different people had different thoughts. With states like Lagos State, Rivers State, even ready to go into the end to say, oh, this is not what list is this in the constitution? Who has a right to even charge this? So that legal yearning is still there, unless there is a clear maybe amendment of the constitution to clearly say who is on this matter. But at least for now, what it has started to do, and I think you touched both things, both in the sharing of between the three tiers of government, and then in deciding when it's shared between the states, deciding the formula of what to give equally and what to give based on derivation, there were concessions. So first of all, when it comes to the three tiers of government, the federal government takes less under the new law than it currently does. That was his way to say, state, I'm giving you more. Keep quiet. Let's just agree. And then when it comes to the sharing between stuff, and like you've said, 30% was given to derivation. I think initially people wanted 60% or at least 50% to derivation, but at least 30% was still seen as reasonable to try and make everybody happy. So at least for now, we expect people to take the back seats. But maybe post the next election, a governor in a state can come that was not part of these discussions and say, no, as far as I'm concerned, I still have a right to take 100%, not just 30% of what comes from my state. So until then, for now, what the agitations are down.
So thank you very much, sir, for that excellent response to the question. Please, if you don't mind, Mr. Joseph, I will just take you I'll take you through some of the questions already asked by our audience. We have a good number of questions now. The first question is from Regina Anichebe. Regina Anichebe has about 3 questions. The first one is, for her, what are the practical ways for lawyers to avoid or reduce tax liability under this new regime? So Regina wants to know that as lawyers, do we even need to pay tax at all? If we need to, please better advise us on practical steps we need to take to either totally avoid or at least reduce our tax liability within the confine of the law. Thank you.
Okay, so because there are multiple questions, I'll just try to be quick with each one, and then if there's any additional need to respond, please let me know. So, and I like the way you put it, based on the confines of the law, lawyers will need to pay tax because we're earning personal income tax, and lawyers are rich people. So we are among the higher band that are expected to pay more taxes.
Are you assuming that we are rich?
Yeah. Am I assuming what?
That we are rich?
Yeah, we are professionals. So at the end of the day, what I would just say in balancing your taxes, I've seen a lot of things in social media. I've seen people say, oh, set up a company. That's the best way to, of course, lawyers cannot, but generally for people, set up a company. That's actually not always sound judgment. And I wanted to answer this question quickly, but let me just tell you why. I see such things and I'm like, oh, these people really need to read the tax laws correctly. Because if you set up a company, that company, instead of paying taxes at the effective rate of 21, I told you, will pay taxes at 30%. That's number one. So that income will still be taxed at 30%. When that company now gives you money as salary or as dividend, you will be taxed again. at the effective rate of 21%. So instead of you as you are being taxed at an effective rate as maybe if you are earning over 100 million of 21% or 22 or 23, you end up maybe paying tax on that same income of at least 40%. So it's not always sound advice. It may be in a case-by-case basis, but it isn't. But to quickly answer the question, I would say for me, the most effective way is to keep track of your costs. You see a lot of people, I see a lot of celebrities online, for instance, say, for what? LIS just charging me to this money. What you see in a lot of the cases is because people have not tracked their expenses to use and deduct from their income. So they are just giving a percentage of their income to pay as taxes. So once you document and everything is clearly shown, it's easy to net it off and pay taxes on only the net.
So thank you very much. Your answer has actually responded to two of our questions. Practical ways to reduce our tax liability as lawyers, and whether we should retain our business name structure or we should convert to. So you have used one stone to kill two birds. Thank you very much. However, our third question is what happens, and I think it is applicable to all practicing lawyers, that for those who are involved in a property practice, that clients pay money into your account for passive income, as we call it in tax. So our concern is how will the lawyer's tax liability be decided? Our fear is, okay, if 5 million should come to my account, am I going to be
think it's my money
when my own share is just barely 10% or 5%? So please help us engage the question, sir.
So I will just start by making a general comment that is why best practice, and I was talking with a lawyer, maybe based on the RPC, is to have a separate account for this kind of clients' monies. So even when they enter, it is clear to whoever is coming to see your book that that is a client account. It is not your account. Any money in there, you are keeping in trust for the client. And even when you want to take your percentage, you will then transfer your percentage from that client account to your account. That way, the tax authority knows when they come that any money in there is most likely not your money. But if it's the case where you mixed it, then your documentation would also help you, including the agreements that shows that it's only a percentage of this that is your money. And then you have your bank statement that then shows the outflow of the net that can be tied to the amount in the in the agreement that is not your own, that is then transferred to the owner of the assets. So at the end of the day, it is documentation that can help you resolve this issue.
Thank you again, our guest speaker. I would like to reiterate again that your question also has, your response has taken care of the following question asked by Odinga Blessing, because our question also tilted towards issues of money in the account not belonging to the lawyer, so to say. So thank you very much for that response. Now we move to Mercy Osai. Our question is, how do taxable persons get their tax ID?
Okay, good question. I don't have all the answers, but like I mentioned during my session, especially when I was talking about meats, there will be no need to register and get a separate number called a tax ID. If for a company you have a team of, as an employee or as a person resident in Lagos State, either working on your own or working for an employer, if you have a Lagos State tax ID, all those are expected to be merged into a single tax ID. So the answer I will give you, if you're not already registered with Lagos State, is how do you get your tax ID? By registering with the Lagos State Internal Revenue Service to give you their own ID. Once you have that ID, you have no worries about the tax ID in the Nigerian Tax Administration.
Thank you very much. The next question is from Adeola Ijandipe. Sorry if I didn't pronounce your name right. Our concern is about stamp duties. Believing that demand for stamp duty is very high, even for low-income earners like clerks, so who collect less than 80,000 naira per month. So our concern is how will the new tax affect this?
I'm not sure I understand the question because the demand for stamp duties, remember, stamp duties are only payable on dutiable instruments. So for instance, stamp duties are payable on agreements, for lease, agreements for the sale of an asset, etc. And of course, when it is ad valorem, it's a value based on the percentage on the value. It's a percentage based on the value of the assets. So I'm not sure how that relates to the question because, for instance, a low-income earner is not going to be selling a house where they need to pay stamp duties on. So in that case, I remember when I was going through the provisions of this new act, I now said for leases of less than 10 million, it has now been exempted from stamp duties because as it is, most of our rental agreements for most of us are actually supposed to be stamped, but they are not. Well, now this has created an exemption to say in those cases, especially if it's a lease, you don't even need to stamp because it's lower than the threshold.
Again, thank you very much. When I saw the question also, I didn't get the full grasp of the question, but I was thinking probably he or she was trying to ask with respect to the e-receipt and all those transfers that we do. But again, as Riley said earlier, over the personal income tax of a low-income earner, we all know what they charge for the transfers that we do, 50,000, 15 naira and all that. So I think that is fair enough. Now, there's an anonymous question here. I can't say the name of the person asking the question because it logged in with a device name. It says, sir, if small companies are not expected to charge VAT, then will there be any need to be registered for VAT so as to get VAT certificate?
Sorry, I was muted. Good question, but there's no separate thing called a VAT certificate. But if you, as a small company during a year, so let me just clarify what I meant by that. So first of all, there's, for instance, no simple separate number as a VAT number as a tax ID number. When you register for taxes in Nigeria as a company, you get a single tax identification number. That is the number that is used for income tax, is the same number that is used for VAT. So as a company, if you are already registered for taxes and you do not have, so for instance, most times now, once you go through the CAC process, it's easy to then get your TIN. You have your TIN already. You are not just issuing, what's it called? You are not collecting, charging and emitting VAT because you do not meet the threshold. But as soon as you meet the threshold, as soon as it's triggered, you need to start.
So thank you very much for your response. The next person, the question is a little bit wide by Victoria Ujiola. I don't know how you can help us to be very, very succinct or brief. He said, kindly explain CGT liability.
So, like I said, CGT was a separate law, but it's now part of the income tax law. So CGT is simply saying it's capital gains tax. What it simply means is you make on a sale of a capital asset is supposed to be liable to tax. So for example, if you purchased a house for 100 million, you registered, you did your perfection, stamping, everything for 20 million, etc. So your general total cost at the end of the day for having the house is 120 million. And in 5 years' time, you want to japa, for instance, and you sell that house 500 million. You've made a gain of 380 million because on all these assets, they appreciate. You've made a gain of 380 million. Government too wants to eat from that money. So that 380 million is what we call the chargeable gain. Throughout the presentation, you saw me using the word chargeable gain. That 380 million is a chargeable gain. Currently, we would see 10% of that 380 million, 38 million. Say go and pay 38 million to government. But now, if it's a company, we will do 30% of it and say go and pay about 116 million or thereabout, about 120 million to government. If it's an individual, we'll put it inside, we'll add it to your income, do the graduated table, And maybe at the end of the day, you can end up paying 25% of it since it's over 100 million. So that's what the entire concept of capital gain. On any capital asset, shares is also an asset. So I used an example at one point of shares when I was talking about a UK-US company. If you bought the shares in the company for 100 million and you're selling for 200 million, that's a chargeable gain. And you're selling the company for 200 million, that's a chargeable gain of 100 million. So you pay capital gains tax on it. But now called a single income tax.
Okay, thank you very much for your excellent response. Your response seems to have taken care of the next question asked by Kennedy on capital gain tax again. But I don't know if you have anything to add to it. But his question borders on fixed asset gain, that if a property was bought last year at the price of 100 million naira, and now it has been sold at 150 million naira. So his concern is how will capital gain tax be assessed under the new Act?
So that's basically what we've said. That's 50 million, saying that there's no other cost. General cost and chargeable gain is 50 million. It's a company to be taxed at 30%, like we've said. 30%, but remember that it's also a 4% development levy because you will add it to the total income of the company. If it's an individual, we'll take you through that graduated table we spoke about that starts from 0, 15, 21, all the way to 25%. So,
okay, thank you.
Yeah.
Thank you, sir. The next person is Choma Uguru, and she wants to know what will be the liability of a taxpayer if, based on the old liability, he has been charged with tax, and now, under the new law that will commence in January 2026, that which one will be applicable, the whole liability, or how would the new law treat such liability?
I think this is one area that we lawyers like to thrive. I remember when I went for a case with the tax authority and the guy immediately said, "Are you a lawyer?" We know we hate hearing anything about retrospective application. So if I have a liability under the old law, you cannot come and use the new law to apply to it. So that's where one area we thrive as lawyers.
Thank you very much for your response. But the point is, if your liability is for the previous year and you have not paid, under the available tax laws, even though what do we call this principle in law? The principle of law cannot be applied retrospectively, statute of limitation. I think our tax laws are clear about that relevant tax authority can actually reassess you to tax or even assess you to tax, provided it is not more than 6 years. But even the 6 years can still be extended if there is a case of fraud against you. So again, thank you very much for, it's an area that we all like to thrive.
Yeah. So let me just also add, and thank you for adding that. So at the end of the day, let's say, for instance, the law starts next year and the tax authority comes and says, in 2022, you are supposed to pay this. Yes, because 2022 is still within 6 years, they will assess you to tax, but they will assess you to tax on that 2022 based on the old law, not based on the new law. So that's just to
Thank you very much. There is a question from an anonymous. It says, are lawyers as individuals other than firm expected to charge and file VAT? And it says, if yes, will the lawyer need to register for VAT before he or she can charge and file the VAT?
Yes, so law firms are actually supposed to charge VAT. And like I said, once you are registered for taxes, you are supposed to then charge VAT. You are supposed to, you have your VAT number, you charge the VAT, and you're supposed to remit them to government. If you don't remit them, the government will come for an audit and they'll charge you interest and penalties for not charging. But remember, like we said, if you are not making up to 100 million in a year, then you are exempted from charging VAT.
So thank you very much for the response. We have Segun Adewumi here who would like to know, after commending you for a paper well presented, he said he would like to know the fate of taxpayers as far as a 5% surcharge is concerned. I think you also touched it in your paper.
Yeah.
Now, what impact is it going to have, especially with focus on fuel?
Yeah. So we don't know when it's going to be implemented. So as for that part, your guess is as good as mine. Those in Aso Rock may already know when they want to implement it. I don't know. But one thing is sure, there are concerns that when it is implemented, it's going to increase inflationary trends because, of course, if fuel right now is 900 naira per liter, then you have to be adding 45 naira to that. It now becomes 945 because that's the 5% surcharge. But one thing I should note is that I think that surcharge is said to be for imported fossil fuel. So some other people have also said, oh, it's Dangote that is bringing this up because he wants people to buy only his fuel. So you see everything everywhere. But at the end of the day, I don't know when it's going to start. Of course, it's going to lead to increased fears of inflation. But until that comes up, we cannot say for sure.
Thank you very much, Mr. Guest Speaker. The next comment is from our host, the chairperson of FAC. Our own is more of thanking you and appreciating you for your insightful presentation. So thank you very much. Now, moving to the next is Segun. Now, his question borders on VAT legislation. And he wants to know that certain transactions relating to supplies made or purchases in connection with children clothing, to children's clothing, books used were regarded as zero-rated supplies, and they are no longer zero-rated supplies or are referred to now as under the new law. I think his question borders more on what is now zero-rated under the old regime and now under the new regime.
So I don't know the specific question, but what I would just note is that there are a few items that are currently exempt that have been moved to zero rated, and some people fear to say why that move. That move is supposed to be a consumer friendly move, and I gave that example to say if an item is exempt, you cannot claim your input VAT, but when we put it under zero rated, the people that are charging that thing can charge it at 0% and also claim their VAT. So, but I don't know if that answers the question because I was not clear on the question.
Okay, thank you very much. The next question is by Olubola Afolabi. After commending you for a paper well presented, she wants to know the requirements to link TIN with banks. I think he wants to know the requirement for linking of TIN to your bank account.
Yeah, so like I said earlier, for now, there is no action that anybody has said we should do. Once you have your team, you have NIN with the bank, all these things are supposed to be aligned. And if at the point of doing your KYC, of opening that account, the bank has gotten all the information they should. For now, we do not expect, and that's why when we see apprehension of people that say, oh, because I do not have a tax ID, my account is going to be closed. Even at worst, if there are people that gave information that were not complete at the point of opening their account, their customer representative may just reach out to them to ask for further information. So there is no requirement right now to link anything to bank. So, but if for instance you want to say you know that at the point of opening your account as a company, your TIN was not provided and you want to You can walk up to your bank and say you want to update your details, just the same way you update your phone number or your address. So that should not be an issue.
Okay, thank you very much. We have another question by Victoria Ojola. I think this is the second time that Victoria will be engaging you on a question and answer. She wants to know tax benefit associated with registering your firm as a LLP, a partnership, as against a BN, a business name.
Okay, so that's a tough one. It's not a question we can fully dissect or digest in a session like this. All I would say is, especially, and I'll explain why. So especially, for instance, or how do I put it? So LLPs could have a form of a company or could be seen in the form of a company. So what that means is if you look at the Nigeria Tax Act and say it's under the bucket of a company, then the tax implications of a company would apply vis-a-vis an individual. So you need to look at it on a case-by-case basis, like I said earlier when I was talking about people going all ahead to create a company. So that's a tough one. It's not something that you can just simply say, this is the best approach, or these are the tax benefits. But of course, there are tax incentives for companies that will then be applied to LLP that will not apply if an individual was having the same business.
Thank you very much. The next question is from Anonymous. He wants to be clear as to how small companies that produce or import goods under VAT regime will be able to recover their import VAT, according to him. Since
Sorry, can you say that again? I'm not sure I got it.
he wants to know how small companies that produce or import goods can recover their import VAT. Maybe he wants to.
Their VAT on import. I understand what it means. So remember, that's why I talked about refunds, because in that case, you would have input VAT, but you will not have outputs. What you can do is to apply for refund in that case, which is why I talked about refunds in my myth versus reality. Because like we said, a lot of things that are currently VAT exempt are being moved to zero rated to enable more people claim their input VAT. And if it's in products that are zero rated, of course, there will be no output VAT. So it's the same thing as such people here. In those cases, you need to go and ask government to give you your money back.
Okay, thank you very much. The next question is from Chioma. Chioma wants to know, it says, what about things like company registration? With the profit or professional fee that we transfer to our personal account from the tax law firm's account be taxed? Then yes. At what percentage would they be taxed?
Even currently, incomes that you earn as professional fee from registering companies are currently taxable. So it's not a new introduction from the law. It's taxable at what rate? The rates we've said. If it's an individual, remember a partnership, for instance, there is no tax on partnerships. If it's a law firm, for instance, that have partners, those partners get their share of profits. And it's only the partners are then taxable in their individual names. Those partners will then apply the tax rate for individuals. If it's a company, of course, you use 30% after removing all expenses. Because, for instance, that's why somebody asked a question earlier, and I said it's documenting your expenses. So, for instance, if you get professional fees in registering a company, you would have expenses. You would have a car that you use to go to CAC, etc. You would have an office that you are using data cost to maybe subscribe to MTN, Fiber One, etc. Those are costs that a lot of companies don't know are actually tax deductible because they don't keep records.
Thank you very much. The next question is from Mercy. Our concern is to know how our professional fees as lawyers will be charged. by the relevant tax authority.
So when you say charge, there are two things. Number one is how will they be detected? So of course, as lawyers, we're supposed to do the right thing. How will they be detected? So the government has made a lot of strategized a lot of devices to help better the detection, including the tax ID for accounts. So that, and the fact that bank accounts with a minimum amount of money per month, banks have an obligation to file a return to the tax authority. So they will see the name of the bank account and say, why did you get this much money? And then wait to see your tax return. So that's for the detection. And then for the payments, everything we've said. I don't know if that answers the question.
Okay, thank you very much.
Yeah.
The next question is from Abimbola Akinsanya. He says, I'm a resident in Ogun State, but my office is in Lagos State. Am I going to pay my tax in both states?
So the position of the law has not changed on that matter because we have a lot of them, and I've heard this question over and over again. Based on the provision of the law, your taxes are supposed to be paid in Ogun State. But you see a lot of companies, because of convenience, they are reluctant to pay to Ogun State because most of their employees, maybe 90% of their employees are residents in Lagos. So they just prefer to pay your taxes to Lagos State. While that is fine, that may give you issues in future, and I'll explain. If as a resident of Ogun State, for instance, tomorrow you want to get maybe a contract with Ogun State government, or you want to get one of the benefits and they say you need a TCC as a resident, if you bring a Lagos State TCC, they will not oblige you because it doesn't show that you are an Ogun State resident, and that's just from the point of view needing something. So, for instance, if you also decide to run for government, you say at that point they tell politicians to bring TCCs, and when you see the values in those TCCs, they make you wonder whether I earn more than some of these politicians. Those are some of the things you see because people are not paying the taxes they should. But because we see this happen a lot in practice, a lot of companies pay taxes of such people to Lagos State, but they're actually supposed to be paid to Ogun State.
Thank you very much. The next is really not a question. I think it's more of a comment. That's by Olubola Afolabi, who says that with regard to the question on stamp duty, that relevant tax authorities usually ask for evidence of payment of stamp duty before registrable documents are stamped if you are a signatory or a donee or donor of a power of attorney. So I think that is more of a comment, a follow-up comment on the question asked earlier. The next question is from Clement. Clement wants to know whether retired lawyers who live on marginal production supposed to pay tax.
Well, I would say, that marginal production is relative. Some people's marginal production is more than some people's full income. That's on a lighter note. But at the end of the day, if I don't know what you call marginal production, but at the end of the day, if you earn income, all incomes are taxable, subject to the 800K, like we said. But for instance, if it is an actual pension, those are then tax, tax exempt. Pensions are tax exempt. So it depends on what you call marginal production. If it's actual income, maybe if what you're calling marginal production, for instance, is giving advice without going to the office, that's actually still a professional fee and it's liable to tax.
Thank you very much. I also believe that the law really does not give exemption because you are retired. If you are earning something, you just have to pay.
Some retirees earn more than some of us that are working, so you need to put that in context.
Yeah, thank you very much. Kennedy is more concerned, but it's Kennedy's second question, and I'm happy that people are really asking you questions. Is a testament to the fact that your presentation was lucid and very insightful. So, but his concern is that looking at the new law, he wants to know what are the benefits that businesses will really enjoy under this new regime. He believes that it is more of heavier burden on businesses. That by the time you had the 30% of company income tax with the 4% development levy, that is a lot on companies that are not small companies. So he wants to know your take on that opinion, sir.
Okay, so the caveat is that I am not a speaker for government. So that's why when I talk about incentives, and I didn't even put incentives in this slide, I try to balance it. But what I would say is that especially if you, and I think I saw Taiwo Oyedele put a post up on 50 incentives in the tax laws. While some of them may be basically similar, there are actually some major incentives that government is giving away in these new laws when compared to the current one. Even that what you call 34% is one of them, and I'll explain why. Because what we currently have is the tertiary education levy alone of 3%, or 2.5 before. You have IT levy, 1%. You have ITF company, okay, that one maybe still there, ITF. You have police levy, and all of them, at the end of the day, they were like 5-6%. It's coming down to 4%. That's number one. Number two, this impute VAT we're talking is a major difference, because when companies were expensing them, they're only getting 30% of the benefits. Companies are now going to be getting 100% of the benefits. And in few cases, like the one somebody mentioned, companies would even go and ask government for a refund. And if that refund works, get money back. You were not even having any issue to get a refund because that money was usually gone, or you actually paid output VAT. So when you look at everything as it is, these are actually some critical incentives in the law that the government is saying they are giving us an investment to improve the economy. Of course, you can talk to people on the other side that will then pick holes to say they look like short-term benefits, but then in the longer term, companies are paying more. Companies are in sectors that, for instance, that were not going to be paying all the 6% levies are now forced to pay the 4%. So it depends on who you are talking to. But you need to also appreciate that there are actually incentives, including, I don't think I mentioned it, but I think it's in my paper, the priority sector incentives that we now have.
Thank you very much for that very insightful response. In fact, the scope of priority companies has been so enlarged, especially for those who function within the informal sector. So thank you very much for your response. The next question is from Chiamaka Ikesuagu, and I think our question has been answered by our host, the chairperson for this webinar. She wanted to know whether you will make your slide or your paper available, but our chairperson has promised that your paper will be made available to all participants. So thank you for that. The next question is from Chester, and the question is a little bit tricky, but I will just summarize it at this so that you can help us throw more light on it. That with all these taxes that we are being inundated with by government, how do we hold the government responsible or accountable so that at least we'll see some form of dividends for our hard-earned money paid in tax? Thank you.
Everybody say we, because it's also my hard-earned money. I don't think I have an answer that does not dabble into politics. But one thing I would say is we all owe a duty of care to hold governments responsible, especially as lawyers. We can't shy away from it. If you look at the Nigerian Revenue Service Act, it includes a lot new provisions about returns that both NRS and state boards need to now be making to the Ministry of Finance, who have to also place it before the National Assembly. Some of these things are meant to improve transparency about how much monies are made, how much incentives they give people that people may say as their friends, and then help us to then see how the monies are used. So sometimes we have these provisions of the laws, even for our budgets, medium-term plan, etc. It is about the implementation. So we also all have that part to play, because sometimes you see, for instance, that the Auditor General of the Federation has not produced books or has not placed before government books for the last 5 years, and everybody is sitting down. So we all have a part to play. I guess that's what I would say.
Okay, thank you very much. The next question is from Agbomagan LP. I think we may not be able, the organizers will be able to address that. He wants to know whether the recordings of this webinar session will be made available to everybody in addition to your paper presentation. However, let me move to Chioma. Chioma is asking question with respect to VAT. And our opinion is that law firms not making up to 100 million naira per year are exempted for VAT. But what about our professional fee that is being earned in individual capacity, that will it be subjected to VAT?
No, so when you say subjected to VAT, you mean professional fees that you charge your clients, correct? So
yeah, I think so.
Sorry?
I think that is.
I assume that's what Chioma means. And if that is what she means, that's your revenue. And if all your revenue at the end of the day as an individual that is charging is not up to 100 million, then you don't have a responsibility to charge VAT.
Thank you very much. The next question is from Olubola Afolabi. Bola Afolabi, he wants to know what your take is on issues of multiple taxation under this new regime.
I think that's one of the things I try to start with. And if you listen to, I think I've mentioned it before, Taiwo Oyedele speak, this is one of the things that I would say even brought into the limelight in leading that committee. The fact that we have multiple taxes, radio, parking, etc. Why some of them would not go? What you find out in that first slide when I was talking about the laws that were repealed, etc. And when you look at the Joint Revenue Board Act and the fact that they want all the state tiers of government to align, one of the most important things the tax reforms try to address is curb the multiplicity of taxes, e.g., the 4% development levy we said that replaces all those different taxes that we have in different laws. Some of them, companies do not even know they have that obligation because they are just put as one section in different laws. So what this NTA tries to do is combine everything into a single tax and avoid that preparation of different taxes.
Okay, thank you very much. I think although this may sound repetitive, somebody is asking question again, bordering on the VAT you had earlier addressed, that he didn't get your take on it. That are you saying that companies will have to pay VAT, or that if a lawyer provides services with respect to drafting of agreements and documents, will that lawyer pay VAT on the professional fee collected from such a endeavor?
No. So that's not what I said. Let me repeat it in case, but I think I was clear about it. I'll try to clarify again. The question that was asked on professional fees for registering companies was about income tax. And I said that, yes, that is a taxable income of a lawyer. If a lawyer earns 5 million naira from registering a company, filing the company's annual return, change of directors, etc., that 5 million naira is a taxable income in the hand of the lawyer. So we put it through the graduated table. VAT is a different thing. For VAT, I said that it is only companies that then, or individuals, so firms, businesses is the word I should use, that earn up to 100 million in a year that have a responsibility to charge VAT. And I'll give you, I explain. So for instance, if last year you didn't make up to 100 million, this year there is no point charging VAT. And you don't expect to make up to 100 million this year. There's no point charging VAT on your clients, on invoices they are issuing to your clients. But if in June, for instance, you get one big contract and you pass that threshold, then you need to start charging VAT. But for instance, if last year you made up to 100 million, then for sure, let's say you made 500 million last year. Nobody needs to tell you that this year you won't say from January, for instance, I won't charge VAT because I've not made up to 100 million. Or because you expect already to make up to 100 million, then you should be able to then charge VAT from the onset. VAT is different from income tax. Income tax, whether you like it or not, once you pass 800,000, you are chargeable to VAT. So my answer to that particular question was on income tax, to say yes, professional fees are liable to income tax, but for VAT, we look at the threshold.
Thank you very much for that clarification. I think the chairperson has addressed the question on availability of recording of this webinar section. Thank you very much, chairperson. And I think the last question here is on I think we've exhausted all the questions. So thank you very much.
I felt like I was on the hot seat.
Well, your session has been a very insightful one. We've all learned a lot from the practical angle. So thank you very much for your paper. At this junction, I'm going to, I think my job is done. We appreciate the organizers of this webinar section, the fourth quarter webinar, MBA Ikeja Branch. We appreciate our chairman and we appreciate our wonderful audience who are here. I'm going to yield the ground to Mr. Patrick Nwachukwu for vote of thanks, and we bring the webinar section to an end. Thank you very much.
Thank you, Dr. Philip Folarin, for that wonderful work you've done moderating this session. My job here is simple, and that's just to appreciate every one of you, starting from our erudite guest speaker. He has shown from the lecture that he delivered today that he is indeed a man who is grounded in tax law. In spite of all the numerous questions that came, he dealt with it in a very dexterous way, and we are indeed very grateful for the time you have taken to come. I'm talking about the guest speaker, Mr. Joseph Alatishe, who is an associate director in Deloitte, Nigeria. We are so honored to have you here with us. While we are thanking you, we will not also fail to thank the Deloitte team, particularly Mr. Babajide Okunola and the entire Deloitte Nigeria for the support that you have given to us. This is about is it the second or the third time that we have called on you, and you have readily come to support Ikeja Bar. On behalf of the Ikeja Bar, we are very grateful to you, and we thank you for their wonderful support. I will not end this vote of thanks without thanking our able chairman, the chairman of the Ikeja Bar, Mr. Adeniyi Quadri. He has been a fantastic chairman in terms of his support to this our committee, the Finance Advisory Committee. Many people may not know the Finance Advisory Committee is a brainchild of this present administration, where our able chairman, the treasurer, and the chairman himself had put together this. I'm sure many people are already seeing the wonderful work this committee has been doing in the life of Ikeja Bar. So, Mr. Quadri, we appreciate your support, and we won't stop asking for it from time to time. This committee is still going to come back to you, and we hope that you will answer us. I also will thank my chairman. My chairman. When I say my chairman, people, you know, I'm talking about no other person but the treasurer of the Ikeja Bar Association, Miss Ganiya Tadisa, who has been the one who has been leading this August committee. It's been a privilege to work closely with you, and I appreciate all that you are doing. And I thank you, as I also thank all the members of the Finance Advisory Committee and the entire ESCO of the Ikeja Bar. Finally, I will not fail to thank our wonderful attendees. What could we have done today if not for your support? Most of the times, when a seminar is a paid one, so many people don't want to spend their money, and I have no doubt that none of you will regret your coming here today. It's been a very insightful section, and I know that even the engagements that you made during the course of the session itself, wonderful and intelligent questions expected of lawyers of your caliber. We are indeed happy about it because your participation has made today's webinar very, very interesting one. So on behalf of the Ikeja Bar Association and the Finance Advisory Committee, we want to thank every one of you for your time, for the expense you have made, and for the patience you have had to be on this call for over 2 hours.
Apologies, sir. You have not thanked our moderator.
Okay, well, I thought I started from him, but again, I cannot. Thank you, Daniel. Yes, our moderator, Dr. Philip Folari, the of the University of Lagos. No doubt, from the way he conducted this entire session, nobody will be doubting about his ability. And I'm sure your students in Unilag will be very proud of you, because you showed to everyone that you are indeed one who understood everything about the tax law. The way you have moderated the session was very, very beautiful, and we are grateful to you. To you, Leonard Six, here present, distinguished members, senior members of the bar, our colleagues, and the general public, we want to appreciate you and wish you a lovely day as you go about the rest of your day. Thank you for coming.
Thank you very much.
Thank you, sir. Thank you, everyone. You have a great day.
No, of course.